Introduction to Business Financial Planning for Sustainable Success. Understanding business financial planning. Business financial planning plays a vital role in helping companies manage resources, achieve profitability, and plan for future growth. This video introduces the essentials of financial planning for businesses at all stages. By learning to forecast, budget, and monitor cash flow, businesses stay ahead of financial challenges and opportunities. Why financial planning matters. Financial planning ensures that businesses allocate their resources effectively to meet both short-term and long-term goals. It helps to identify risks early and create strategies for mitigation. Businesses that plan financially can maintain steady liquidity, profitability, and sustainable growth. Well-documented plans also build investor and stakeholder confidence. Example: Kenya's Bidco Africa uses financial planning to manage expansion across East Africa, while globally, IKEA forecasts resource needs for new store launches to maintain cash flow and brand integrity. Core purpose of business financial planning. Financial planning enables a business to manage income, costs, and investments efficiently. It prepares companies to meet financial targets while staying financially stable. Strong planning also guides smarter decision-making and helps secure long-term success. Types of financial planning. Strategic financial planning focuses on aligning long-term financial goals with the broader business strategy. Operational financial planning supports day-to-day activities like budgeting and cost control. Contingency financial planning prepares the business to handle unexpected events like economic downturns or natural disasters. Example: Many Kenyan SACCOs implement contingency planning to maintain operations during financial shocks such as droughts or currency fluctuations. Components of a financial plan. Forecasting, projecting future income, costs, and profits. Budgeting, creating detailed spending plans. Cash flow management, monitoring money coming in and going out. Financial statements, tracking performance through structured reports like balance sheets and income statements. Financial forecasting in practice. Forecasting estimates a company's future financial performance. It supports better decisions on investment, hiring, marketing, and expansion. Common forecasts include sales forecasts based on demand trends, expense forecasts using past patterns and operational plans, cash flow forecasts to ensure liquidity. Example: In Kenya's tech sector, startups forecast sales and expenses to determine how much venture funding is needed and when. The budgeting process. A budget outlines how a business intends to spend its money over a specific period. Types of budgets. Operating budget for daily expenses like payroll and utilities. Capital budget for equipment, property, or technology upgrades. Cash flow budget to manage liquidity. Budgeting steps. Identify income sources. Estimate expenses. Set financial goals. Monitor and adjust regularly. Managing cash flow. Cash flow management ensures that a business has enough cash to meet daily obligations. Key elements. Cash inflows, sales, investments, loans. Cash outflows, wages, supplier payments, debt service. Tools used include cash flow statements, projections based on upcoming costs and revenues. Example: A Kenyan agribusiness plans cash flow around planting and harvest seasons, while globally, Netflix manages inflows to match its content production cycles. Using financial statements. Financial statements are the backbone of informed financial planning. Income statement tracks revenue and expenses over time. Balance sheet provides a snapshot of assets and liabilities. Cash flow statement records actual movement of money. These documents help businesses track performance, prepare budgets, and make strategic decisions. Setting financial goals. Effective goals fall into two categories. Short-term, improve profitability, reduce debt, control costs. Long-term, expand operations, increase equity, build reserves. Apply the SMART method. Specific, measurable, achievable, relevant, time-bound. Example: a Nairobi-based clothing brand may set a SMART goal to increase net profit by 15% in 12 months by optimizing production and reducing imports. Risk management in finance. Risk management involves identifying and preparing for potential financial threats. Common risks include market risk, currency volatility or inflation; credit risk, late payments from clients; operational risk, disruptions in logistics or staffing; mitigation strategies, diversify income streams; maintain cash reserves; use hedging for currency protection. Example: Kenyan tea exporters use forex hedging to guard against shilling depreciation when receiving payments in dollars. Financial planning in business strategy. Financial planning is not separate from business strategy, it's deeply connected. It ensures resources are available for strategic initiatives. Budgets support key business goals, from product launches to talent acquisition. Ongoing financial reviews ensure strategy remains financially viable. Tools for financial planning. Software tools, Excel, QuickBooks, and modeling tools simplify budgeting and reporting. Dashboards, real-time visual summaries of performance, e.g., Tableau, Power BI. Scenario analysis, testing different financial outcomes to plan for best case, worst case, and realistic scenarios. Financial planning best practices. Consistency, update plans regularly as circumstances change. Data-driven decisions, use facts and trends to guide planning. Flexibility, adapt budgets and forecasts when market conditions shift. Internal communication, ensure all departments align with the financial plan. Example: international hotel chains like Marriott revise budgets monthly across departments. Kenyan hotels like Serrari use similar structures during peak and low tourism seasons. Real-world example: business profile, a Nairobi-based printing company. Challenge, limited cash reserves and irregular revenue. Action, created monthly cash flow forecasts, restructured budgets, and established contingency savings. Result, improved cash predictability and achieved profitability within one fiscal year. Final takeaway: financial planning is a critical tool for every business, regardless of size or sector. It helps forecast revenue, control expenses, manage risks, and align with strategy. Kenyan and global success stories show how businesses thrive through strong financial discipline. Planning isn't just about numbers, it's about building confidence, direction, and long-term sustainability. Your financial future starts now. Now is the time to plan smarter. Are your business goals supported by real financial data? Do your budgets align with your strategic priorities? Are you prepared for risks and unexpected financial shifts? Start building a resilient business today with strong financial planning. Thank you for watching.